You missed Nvidia, you missed Micron, you missed SanDisk, but those were just the beginning. Here's the thing nobody's telling you. You didn't actually miss anything. The game hasn't ended, it's just getting started. Over the next few years, a whole new wave of stocks is going to do the exact same thing, 10 times, maybe more, and I'm going to show you exactly how to find them before everyone else does. But you have to watch this whole video because the method only works if you understand every piece of it. No fluff. Let's get into it. Here's what I want you to understand before we go any further. A 10 times stock doesn't happen randomly. It's not luck. It's not a hot tip your cousin heard at a barbecue. Every single stock that went up 1000% had a pattern behind it. The same pattern over and over, going back decades. Amazon in the 2000s, Apple in the 2010s, Nvidia in the 2020s, different companies, different decades, same underlying structure. And once you see that structure, you start noticing it everywhere. You can't unsee it. I've watched people chase 10 times stocks by scrolling through Reddit threads and buying whatever's trending that week. That's not a method. That's gambling with extra steps and a stock ticker attached to it. What I'm going to walk you through today is a real process, step by step, something you can actually repeat every single time you go looking for the next one. Not a feeling, not a vibe, a process. Let's start with a story because numbers stick better when they're attached to a person. In late 2015, a guy named David worked in IT for a mid-sized company. He wasn't a fund manager. He wasn't a finance guy. He read tech news for fun on his lunch break. And every week for about 2 months, he kept reading the same phrase in different articles. AI research labs are running into a hardware bottleneck. Not a headline. Not a buy this stock article. Just a repeated technical detail buried 3 paragraphs into pieces about machine learning research. Nvidia was trading around $7 a share at the time, adjusted for splits. David didn't have some secret insider information. He just read the same sentence enough times to take it seriously and put in a small position, a few $1,000s, money he was fully prepared to lose. He didn't sell in 2017 when it doubled. He didn't sell in 2018 when the stock dropped nearly 50% during a crypto mining crash that temporarily tanked GPU demand. He held through a pandemic, through a chip shortage, through an AI boom nobody saw coming until it was already happening. By 2023, that position was worth more than 50 times what he put in. I'm not telling you this story to make you feel like you need to find the next Nvidia tomorrow. I'm telling you this story because every part of it, the reading, the pattern, the small position, the years of holding through terrifying drops, that's the actual template, not the ticker, the process. Step 1, read the news like a detective, not a consumer. Most people read financial news to stay informed. That's the wrong reason. You should be reading financial news to find the sentence that everyone else skips past. Here's what I mean. When Nvidia was trading under $10 a share, the news wasn't saying buy Nvidia. The news was saying things like AI research labs are running into a hardware bottleneck and gaming GPUs are being repurposed for machine learning workloads. Nobody connected those dots out loud. The people who made the connection quietly bought shares. The people who waited for a headline that said Nvidia is the AI stock bought in years later, after most of the move already happened, at prices 20 and 30 times higher. So when you're reading the news, you're not looking for stock tips. You're looking for a shift in demand that hasn't been priced in yet, a new law that changes an entire industry's economics overnight, a new technology hitting a tipping point where it goes from experimental to essential, a shortage nobody's talking about yet because it hasn't hit consumers directly, a supply chain problem that's about to become permanent instead of temporary. That's where the money is made, not in the headline, in the sentence underneath it. I've seen people read the exact same article as everyone else and walk away with nothing while someone else reads it and walks away with an idea worth investigating. The difference isn't intelligence. It's the habit of asking one extra question. If this trend keeps going for 3 more years, who benefits the most? Step 2. Find the sector before you find the stock. This is where most people get it backwards. They fall in love with a company first, usually because a friend mentioned it or they saw the logo somewhere, and then try to justify why it'll go up. Flip that entirely. Find the sector that's about to get a tailwind and then find the best positioned company inside it. Think about it this way. Semiconductors didn't 10 times because one company was special and lucky. The entire sector got a tailwind. AI demand, data center build-out, the shift to more powerful chips everywhere, from phones to cars to server farms. Multiple companies in that sector ran hard. Nvidia ran the hardest, but Micron ran too, on memory chip demand tied to the same AI build-out. SanDisk ran too, on storage demand from the exact same trend. If you'd identified the sector shift early, you didn't even need to pick the single best stock in it. You just needed to be in the right neighborhood, and the neighborhood did the work for you. So ask yourself, what sector is under-owned right now, but structurally has to grow because of something that's already happening? Not something that might happen if the stars align, something that's already in motion, already showing up in earnings calls and industry data that the broader market hasn't fully priced in yet because it still sounds niche or boring. I've watched people spend 40 hours researching one single stock while spending 0 hours thinking about whether they picked the right sector in the first place. That's backwards. The sector decision matters more than the stock decision, especially early on. Step 3, look at who's already buying before you. I've seen people skip this step because it feels too simple, too mechanical, not exciting enough. It's not simple. It's one of the most reliable signals there is, and most retail investors never even look at it. When institutional money, hedge funds, pension funds, large asset managers starts quietly accumulating a position in a stock, it shows up in the data before it shows up in the price. You can check institutional ownership changes through quarterly 13F filings, which are public record. You can watch insider buying when executives and board members are putting their own money into their own company's stock. That's a signal worth paying real attention to. Here's the nuance most people miss. Insiders selling means almost nothing most of the time. People sell stock for 100 boring reasons. A house down payment, a divorce settlement, a tax bill, diversification rules their company requires. It's noise. But insiders buying? That's rare. And it's a different animal entirely. That's a person with more information about the business than you'll ever have, voluntarily risking their own personal money on the company's future. When you see a cluster of insiders buying around the same time at their own expense, that's not noise. That's a signal. Step 4. Understand the difference between cheap and undervalued. This is where a lot of people lose real money chasing the wrong thing, and I mean actual money, not hypothetical money. A cheap stock and an undervalued stock are not remotely the same thing, even though people use the words interchangeably. A stock trading at $2 a share isn't cheap just because the number looks small on your screen. It might be $2 a share because the company is genuinely struggling, burning through cash and heading toward zero. The share price by itself tells you almost nothing. Undervalued means the market hasn't caught up yet to what the business is actually worth. Not that the price tag looks small. The way you tell the difference is by looking at what the company actually does with its money. Is revenue growing consistently quarter over quarter? Is the company burning cash to survive month to month, or burning cash deliberately to expand into new markets? Is the debt load manageable relative to their cash flow, or is it slowly strangling the business? A company that's growing revenue 40% a year with a clear path to profitability, trading at a valuation that assumes something closer to 10% growth. That gap is exactly what you're looking for. That gap is where 10 times returns are born. I've seen people confuse a falling knife for a bargain more times than I can count. A stock that dropped 80% isn't automatically a deal. Sometimes it dropped 80% because it deserved to. Your job is to figure out which situation you're actually looking at, not assume the discount means opportunity. Step 5. Think in probabilities, not certainties. I need to be honest with you here, because most people making a video with this exact title won't be. Nobody can guarantee a 10 times return. Nobody. Not me, not a hedge fund manager with 3 decades of experience, not an algorithm, nobody. Anyone who tells you with total confidence that a specific stock will 10 times is selling you something, not teaching you something. What you can actually do is stack the odds in your favor over a portfolio of ideas. You're not looking for one sure thing. You're looking for a handful of well-researched ideas where, if you're right about even one or two of them, the winners more than make up for the ones that don't work out. This is exactly how venture capital operates, by the way, and it's worth understanding because it applies here too. Venture capital firms don't expect every single investment to succeed. They expect most of them to fail completely, to go to zero. But the one or two that hit 20 times or 50 times cover every single loss in the portfolio, and then some many times over. Public market investors can use the exact same logic on a much smaller, more manageable scale, a handful of high-conviction ideas, each one sized so that no single loss wrecks your overall portfolio, instead of one emotional all-in bet on whatever stock you saw trending on social media last night. This single mindset shift from which stock will definitely 10 times to which handful of ideas give me the best odds is the difference between investing and gambling, even though from the outside they can look identical. Step 6. Patience is the actual strategy, not a personality trait. Here's something I've seen destroy more potential 10 times returns than bad stock picking ever did. And it's almost never talked about. People find the right stock, the actual right one, do all the research correctly, and then sell it after it's up 40%, because 40% feels like a real win, and they don't want to risk giving it back to the market. Then they watch, usually from the sidelines, as it goes up another 300% over the next 2 years without them. The stock did its job perfectly. The investor didn't. A 10 times doesn't happen in a straight line, and it doesn't happen over a few exciting months. It happens over years, with drawdowns along the way that will genuinely test your resolve and your stomach. Nvidia dropped over 50% multiple separate times on its way to becoming what it is today. 50%. If you'd sold during any one of those drops because it felt scary, because the headlines were calling it overvalued, you'd have missed the entire move that came after. The stocks that eventually 10 times aren't found exclusively by people with the best spreadsheets or the fanciest models. They're found by people who did the research, took a reasonably sized position, and then had the discipline to sit still while everyone else around them panicked and sold at the bottom. I've watched this exact pattern play out over and over. The person who's still holding 5 years later isn't smarter than the person who sold. They're just more comfortable with discomfort. Step 7. Know what actually kills a good idea. Let's talk about the mistakes, because finding a potential 10 times stock is only half the equation. Keeping it and not sabotaging yourself along the way is the other half. The first mistake is position sizing your entire net worth into one idea because you're extremely confident. Confidence is not the same as certainty, and even the best ideas fail sometimes for reasons nobody could have predicted. A regulatory change, a key executive leaving, a competitor's breakthrough. Size your position so that if you're wrong, you're disappointed, not financially ruined. The second mistake is checking the stock price every single hour of every single day. I've seen people turn a genuinely good long-term idea into a source of daily anxiety because they're refreshing a stock chart on their phone during dinner. That behavior pushes you toward short-term decisions on what should be a multi-year thesis. If you did the research correctly on the front end, the daily price movement shouldn't change your mind. It's just noise layered on top of a long-term signal. The third mistake is refusing to ever revisit your thesis. Patience doesn't mean blind loyalty. If the original reason you bought the stock has genuinely changed, if the sector tailwind reversed, if a competitor made your company's core product obsolete, that's not the moment for stubborn patience. That's the moment to reassess, honestly. The skill isn't holding forever no matter what. The skill is knowing the difference between a scary price drop that's just market noise and a fundamental change in the actual business that changes everything. Let's put this all together with how it actually looks in practice, from the very first article you read to the position you're still holding 5 years later. You start by reading, not headlines, but the details buried 3 paragraphs deep in earnings calls, obscure industry reports, and supply chain news that sounds boring on the surface. You're looking for a shift that's already happening but hasn't been fully priced in by the broader market yet. From there, you identify the sector benefiting from that shift, not just one flashy company inside it. Inside that sector, you check who's already quietly buying, institutions filing their 13Fs, insiders putting their own money in. You separate cheap from undervalued by actually looking at growth rates, debt levels, and what the company is doing with its cash flow, instead of just staring at a low share price and assuming it means opportunity. You size your positions like you're playing a probability game across several ideas, not betting your entire future on one prediction. And then, the hardest part, by far, you hold through the drops, through the boring stretches where absolutely nothing seems to be happening for months at a time, because that's usually right before something finally does. I'm not going to hand you a specific ticker at the end of this video, and honestly, if a video with this exact title ever gives you one with total unwavering confidence, that's your signal to be skeptical, not excited. That's the opposite of what David did back in 2015. He didn't need someone else's ticker. He built the habit of reading for the signal underneath the headline, and that habit is transferable to any sector, any decade, any market condition. What I can tell you with real confidence is that this process, reading for the signal underneath the headline, finding the sector before the stock, watching who's actually buying, telling cheap apart from undervalued, sizing your bets like probabilities instead of predictions, and having the actual patience to hold through the terrifying parts is the exact same process behind every 10-time stock that's ever existed. Amazon in the 2000s, Apple in the 2010s, Nvidia in the 2020s. Different decades, different companies, completely different products, the same underlying blueprint every single time. You didn't miss it, the next one hasn't happened yet, and now you actually know what to look for the moment it starts. If you've got a sector you're already watching or a stock you think fits this pattern, drop it in the comments. I read all of them. And if this helped you look at the market a little differently, I'll see you in the next video.